In this video, we talk about the qualifying criteria for hedged items, especially when dealing with forecast transactions in hedge accounting. When a hedged item is a forecast transaction, one essential requirement is that the transaction must be highly probable. This means there should be a strong likelihood that the transaction will occur as planned. For hedge accounting, hedged items typically involve transactions or commitments with parties external to the reporting entity. However, there are certain situations where intragroup transactions may qualify. For instance, in consolidated financial statements, if a highly probable forecast intragroup transaction involves foreign currency risk that will impact consolidated profit or loss, it can qualify as a hedged item. But if the foreign currency risk does not affect the consolidated profit or loss, the intragroup transaction cannot be designated as a hedged item. In individual or separate financial statements, hedge accounting can be applied to transactions between entities within the same group. However, in the group's consolidated financial statements, most intragroup transactions are not eligible except in specific cases like those involving investment entities under Ind AS 110. To summarize, for a transaction to qualify as a hedged item, it must either involve an external party or, in some cases, an intragroup transaction where foreign currency risk impacts the consolidated profit or loss. Meeting these criteria ensures that hedge accounting remains aligned with the economic substance of the hedge. Thanks for joining me, and see you in the next discussion.